Hey everyone, it's Ahmed. So over the last several months, the Chinese governments, the Chinese regulators have basically imposed a significant amount of incremental regulations on a lot of their companies, and the fervor, the tenacity with which these regulations are basically being imposed on a lot of these companies continues to increase. Needless to say, this has resulted in a significant amount of uncertainty when it comes to the future of a lot of these companies, and due to that, a lot of the stocks for Chinese companies has basically experienced a significant correction of late. So if there is an investor that is looking to potentially invest in Asian markets in order to create this diversified portfolio, which we've talked about in other videos, what country could potentially benefit when it comes to a lot of these Chinese crackdowns? And that's what I want to talk about in this video. But before I get too far into it, don't forget to smash that like button for the YouTube algorithm, subscribe to the channel, and ring that notification bell, and let's get into it. So let's talk about what have some of these Chinese regulators been up to over the last 6 to 9 months here. So a lot of people by now are very familiar with the whole Ant IPO. Ant IPO was basically a component of the Alibaba operation and was supposed to revolutionize the way in which Chinese consumers can basically pay for goods and services as well as receive funding, and it would effectively be a direct competitor to a lot of the banks in the Chinese economy. Needless to say, the Chinese government and the regulators did not necessarily like this fact pattern. They halted the Ant IPO from basically even taking place, and needless to say, the Alibaba CEO, who's this gentleman named Jack Ma, dropped off the face of the earth for several months. More recently, there's been this whole case study around Didi, which is basically a ride-hailer type of company. So think about Uber or Lyft, but more so in a Chinese context, which is really what Didi really is. But when you think about Didi from a numbers perspective, they basically have 500 million users compared to something such as Uber, which has somewhere around 90 million users, or Lyft, which has somewhere between 10 and 15 million users. So it's significantly larger from a ride-hailer perspective. Anyway, this company also wanted access to public markets. They were actually allowed, or they did in fact go IPO, but shortly after that IPO took place, the stock basically cratered based on some new requirements or rules that basically came out from a lot of these Chinese regulators. The Chinese government accused the company of data privacy infractions, including storage of user data in the United States, and also citing serious problems with the collection of personal data, and then ordering app store operators in the country to remove the Didi mobile apps. On top of that, Chinese regulators have of course been including more restrictions when it comes to cryptocurrency mining, and a lot of the cryptocurrency miners have therefore left the country now. There's also been crackdowns when it comes to education stocks. So this whole Chinese regulatory environment is stemming beyond just this whole notion of technology type of companies. What has recently been talked about is that some of these regulations will continue to be put in place all the way through to 2025. Now, this is not to say that these Chinese regulators are completely off base, because at least from a consumer perspective, a lot of these types of regulations may potentially be viewed quite favorably, but it does impact the way in which a lot of these companies, and that is the focus of this particular video, generate a lot of their revenue. So what's been the fallout out of all of this? As I mentioned in the beginning of this video, these Chinese stocks have experienced a significant correction, whether it's Alibaba or Baidu or Tencent or JD.com. If you look at a lot of their charts over the last couple of months here, they have all experienced precipitous declines, and now they've had a little bit of an uptick of late. And a lot of investors, such as the ARK Invest CIO or Chief Investment Officer and Kathy Wood, have decided to take some level of positions in a lot of these companies. But for a regular investor who potentially does not have such deep pockets, there's this whole notion of risk versus reward. Are the rewards associated with investing in some of these stocks open or sufficient enough to justify some of the risks that you may potentially take into investing into a lot of these companies? And I would argue that perhaps not so much, right? Obviously, there is a lot of these factors that we've already talked about where the Chinese regulators have basically infringed into public markets, but there's a lot of demographic type of issues that is taking place in the Chinese economy as well. For example, the population continues to get older and older, and therefore the Chinese government has lifted things such as the one-child policy, policy and has opened it up to 2, potentially even 3 children, because they saw their future may potentially go down the same path as a country such as Japan, which has basically been stuck in this rut for the last couple of decades here from an economic growth perspective. Then there's of course other concerns such as what has basically happened to Hong Kong. There's concerns that could what has happened to Hong Kong potentially also happen to Taiwan. There's also all this conversation that's coming out from the SEC, and some of this have basically been put into law already, which is requiring the Chinese companies to basically, that are listed on the US stock exchanges, to also provide incremental disclosures in terms of their ownership structures, such that an investor truly knows what it is that they're potentially investing in when they buy a Chinese company stock. So where could an investor potentially go? Well, one place that has been doing pretty well over the last year or so has been India, and the Sensex, which is one of the Indian stock exchanges, has been up over 40%, and this particular index is even outpacing a lot of the US indexes such as the S&P as well as the Nasdaq. Amongst all the Asian countries, the India economy is far outpacing a lot of these countries, and when it comes to the fund flow, it's definitely demonstrative as well, as more and more people have started investing into the subcontinent. The value of venture deals in India surged by $7.9 billion in July, while China investments plummeted to $4.8 billion, according to data compiled by research firm Preqin. This is the first time the South Asian nation has surpassed its larger neighbor by a monthly basis since 2013, the firm said. Then there's the tale of startups that are also looking to go public. For example, the company Zomato, since it went public, has experienced over a 75% run. And then there's also this whole story around Flipkart, for which Walmart has taken a significant position. But this company is now valued at over $37.6 billion and is potentially looking to go public in 2022. And it's the overarching growth of the entire economy that also makes this investment rather compelling. For example, in Q2, the India GDP growth has been over 20%, and when you compare that to Chinese GDP growth in Q2, that was just a hair under 8%, and this is even with the global health crisis. And then there's lots of demographic related benefits about investing in India as well. For example, it has one of the largest middle classes in the world, it has one of the youngest population base in the world, and when it comes to that whole notion of consumerism, it's definitely taking hold in the country. When it comes to international investments, the country in itself is one of the largest English-speaking countries with a fairly reasonable cost structure, so a lot of companies will continue to invest, primarily tech companies will continue to invest in this country as well. And the reason why I'm basically focusing very heavily on a lot of these tech companies is because the Indian population is very focused on technology or STEM-related studies, which is obviously very beneficial when you have a lot of these types of tech companies investing in the country. Now, I don't want it all to appear like roses, okay, because there's definitely a lot of risks associated with investing in India. For example, there's this whole notion of bureaucracy. In order to get anything done in India, it does take a significant amount of red tape to be removed, and that usually takes a lot of time. Related to that whole red tape comment is the whole notion of corruption. Quite frequently, it is said that if corruption were in fact a currency, India would be one of the wealthiest countries in the whole wide world. Then there is also a significant amount of infrastructure related challenges there as well. So I'm not just talking about roads and bridges and things like that, but we're also talking about communication. All of that needs to be significantly improved in order to make this country even more compelling. So how do you invest in India? Well, the simplest way to invest in India is primarily through ETFs. It definitely takes away a lot of the risk associated with investing in individual company stocks, and those are primarily through ADRs. The question is really up to you at this point in time. Do you buy into this whole India investment thesis? Do you think there could be other countries that could also benefit quite significantly from a lot of these Chinese crackdowns? Include all of that in the comments below. I hope you enjoyed the contents of this video. Don't forget to like, subscribe, and ring that notification bell, and I will see you in the next one.